What is a centralized cryptocurrency exchange? A centralized cryptocurrency exchange, often abbreviated as CEX, is a platform operated by a company that facilitates the buying, selling, and trading of cryptocurrencies. Unlike decentralized exchanges, centralized exchanges act as intermediaries between buyers and sellers. These exchanges maintain control over all transactions and securely hold user funds, serving as trusted third parties. Unlike decentralized exchanges, which operate on protocols without central authority, centralized exchanges are company-operated platforms that serve as intermediaries. Well-known examples of centralized exchanges include Coinbase, Binance, and Kraken, which are among the most popular platforms for cryptocurrency trading. Centralized cryptocurrency exchanges function similarly to traditional stock exchanges, but instead of trading stocks and bonds, they facilitate transactions of digital assets. An order book is the central matching system that powers centralized cryptocurrency exchanges. The order book displays all buy and sell orders at different price levels. Buy orders are on the left and sell orders on the right. Market orders execute immediately at the best available price. When a user places a market buy order, it's matched with the lowest sell order. For example, if someone places a market buy order for zero point 0.3 BTC, it immediately matches with the lowest sell order at $50,000. Limit orders, on the other hand, are placed at specific prices and wait to be filled. They're added to the order book until matching orders appear. Here's an example of placing a limit buy order for zero point 0.5 Bitcoin at $49,700. The order is added to the book between the existing $40,800 and $49,600 orders. This order book system creates liquidity and establishes market prices based on supply and demand. The midpoint between the lowest sell and highest buy order is often considered the market price. Behind the scenes, exchange algorithms constantly monitor the order book and automatically execute trades when matching orders are found. These algorithms continuously scan the order book, ensuring efficient price discovery and trade execution without human intervention. The order book system is the backbone of any centralized exchange, facilitating transparent and efficient trading while establishing fair market prices. Centralized cryptocurrency exchanges must implement robust compliance procedures to adhere to regulatory requirements and ensure the security of their platforms. These procedures primarily consist of KYC, Know Your Customer, and AML, anti-money laundering protocols. The verification process typically follows a tiered approach. Users begin with basic information, then progress to identity verification, and finally may complete enhanced verification for higher trading limits. Regulatory compliance is a critical requirement for centralized exchanges. By implementing KYC and AML procedures, exchanges can prevent fraud and illegal activities, comply with local regulations, and create a secure environment that attracts institutional investors. While KYC and AML requirements do reduce user anonymity, they create a more secure and regulated environment. This trade-off is generally acceptable for mainstream users and institutional investors who prioritize security and legitimacy. By implementing robust KYC and AML compliance, centralized exchanges can serve institutional investors, attract mainstream users, and operate in regulated markets. While this reduces anonymity compared to decentralized alternatives, it provides the legitimacy and security that many users require. Centralized crypto exchanges employ multiple layers of security to protect user funds. The most important security measure is cold storage, where up to 90% of customer funds are kept offline, away from potential online threats. Exchanges require two-factor authentication, where users must verify their identity through a second device before accessing their accounts. All sensitive user data and communications are protected through advanced encryption, making it extremely difficult for unauthorized parties to access information. Regular security audits by independent firms help identify vulnerabilities before they can be exploited, ensuring all systems meet the highest security standards. Many leading exchanges maintain dedicated insurance funds to compensate users in the rare event of a security breach. Despite these measures, centralized exchanges remain prime targets for sophisticated hackers due to the high value of assets they hold. This is why leading exchanges must continuously update their security protocols, constantly monitoring for new threats and implementing protective measures. Centralized exchanges offer user-friendly interfaces with real-time trading features. These platforms typically display interactive price charts showing market movements over time. The order book displays current buy and sell orders, showing market depth and available prices. Exchanges offer various order types to accommodate different trading strategies. Market orders execute immediately at the current market price, providing fast execution but no price guarantees. Limit orders let you set a specific price for execution, ensuring you don't pay more than your specified price. Stop-loss orders help manage risk by automatically selling when the price falls below your specified threshold. Beyond basic order types, centralized exchanges offer advanced trading features for experienced users. Margin trading allows users to borrow funds to increase their position size, amplifying both potential profits and losses. Futures contracts enable traders to speculate on the future price of assets without owning the underlying cryptocurrency. Many exchanges also offer staking services, allowing users to earn passive income by holding tokens on the platform. Centralized exchanges cater to users of all experience levels, from beginners to professional traders. For beginners, platforms offer simple interfaces with basic buy and sell functions, market and limit orders, and educational resources. Experienced traders benefit from advanced features like technical analysis tools, API access for trading bots, and sophisticated order types. This balance of accessibility and sophistication makes centralized exchanges popular platforms for cryptocurrency trading across all user segments. Liquidity is a critical feature of cryptocurrency exchanges. It refers to the ease with which assets can be bought or sold without significantly affecting their price. High liquidity markets have many orders at various price levels, allowing large trades to be executed with minimal price impact. Low liquidity markets have fewer orders, leading to larger price movements when trading. The order book shows the depth of liquidity at different price levels. It displays all buy and sell orders currently placed on the exchange. In a highly liquid market, the order book has many orders close to the current price. This creates a smooth curve and means large trades can be executed with minimal price impact. In contrast, low liquidity markets have fewer orders and larger gaps between price levels. This results in steeper curves and greater price impact when executing large trades. Centralized exchanges employ multiple strategies to build and maintain high liquidity. These approaches work together to create robust market depth. Market makers provide continuous buy and sell orders, narrowing the spread. Exchanges offer fee discounts and rewards to high-volume traders. Large user bases naturally increase trading activity and liquidity. Institutional partners bring significant capital and trading volume. Dedicated funds used to ensure liquidity at various price levels. High liquidity on centralized exchanges offers several important benefits for traders. First, tighter spreads. The gap between buy and sell prices narrows, reducing the cost of trading. Second, fast execution. Orders can be filled quickly at the expected price, without waiting for counterparties. Third, minimal slippage. Large orders can be executed without significantly affecting the market price, preserving expected returns. These benefits are especially important for traders executing large orders or trading during volatile market conditions. Centralized exchanges generate revenue primarily through various fees. There are three main types of fees that exchanges implement. First are trading fees, typically ranging from 0.1 to 0.5% per transaction. Next are deposit and withdrawal fees, which vary by cryptocurrency and often include network transaction costs. Finally, exchanges charge listing fees for new cryptocurrencies, which can range from $50,000 to over $300,000. Many exchanges implement tiered fee structures based on a trader's 30-day trading volume. As trading volume increases, both maker and taker fees typically decrease, incentivizing more active trading. Maker fees apply to limit orders that add liquidity to the order book, while taker fees apply to market orders that remove liquidity. Many exchanges create their own native tokens and offer fee discounts to users who hold or pay with these tokens. These native exchange tokens provide multiple benefits to both the exchange and its users. Users can receive up to 25% off trading fees by holding or paying with the exchange token. Tokens can be staked to earn passive income, increasing their appeal. Some exchanges offer governance rights, allowing token holders to vote on platform decisions. This creates ongoing demand for the token, potentially increasing its value over time. Fee structures form the foundation of how centralized exchanges generate revenue. The majority of exchange revenue, typically 60 to 80%, comes from trading fees collected on every transaction. Withdrawal fees contribute a smaller percentage, usually 5 to 10% of total revenue. Listing fees for new cryptocurrencies make up 10 to 15% of revenue, but can vary significantly between exchanges. Additional services like margin trading, futures, and staking can contribute another 5 to 15%. Exchanges must carefully balance keeping fees competitive to attract users while generating sufficient revenue to maintain operations and security. Fiat on-off ramps are a critical feature of centralized exchanges. Unlike decentralized alternatives, centralized exchanges provide the ability to convert between traditional fiat currencies and cryptocurrencies. This makes centralized exchanges the primary entry point for new cryptocurrency users. Fiat on-ramps allow users to deposit traditional currencies like US dollars, euros, and Japanese yen using various payment methods. Common deposit methods include bank transfers, credit or debit cards, and wire transfers. Each method offers different processing times and fee structures. However, these services require additional verification steps to comply with financial regulations. Users typically need to complete identity verification, provide proof of address, and connect verified bank accounts. Deposit limits may also apply depending on verification level. Despite these requirements, fiat on-off ramps make centralized exchanges the essential gateway to cryptocurrencies for most users, offering a more accessible entry point than purely crypto-based alternatives. These features represent one of the key advantages of centralized exchanges, though they come with additional regulatory requirements. In this final section, we'll explore the fundamental trade-offs of centralized cryptocurrency exchanges. Centralized exchanges represent a fundamental departure from cryptocurrency's original decentralized philosophy. On the left, we see a centralized model where all users connect through one main hub. On the right is a decentralized network where users connect directly to each other. Let's examine the key trade-offs users face when choosing centralized exchanges. Centralized exchanges offer significant benefits. They provide user-friendly interfaces, faster transaction speeds, dedicated customer support, and seamless fiat currency integration. However, these conveniences come at a cost. Users sacrifice direct control of their assets, privacy, and expose themselves to single points of failure and potential censorship risks. One of the most significant risks of centralization is the single point of failure. If the central exchange is compromised, hacked, or shut down, all users are affected simultaneously. Ultimately, users must decide what matters most to them: the convenience and speed of centralized exchanges, or the self-custody and permissionless nature of decentralized alternatives. Understanding these fundamental trade-offs is essential for anyone navigating the cryptocurrency exchange landscape and making informed decisions about where to trade their digital assets.